You know you need to invest to build wealth, but every time you think about picking individual stocks, it feels totally overwhelming, right? You hear names like Apple, Tesla, Amazon, and you start to wonder, is now a good time to buy? Am I going to buy at the peak? What if I pick the wrong one and lose everything? It's a full-time job just to keep up, and that fear of making a massive mistake can be paralyzing. But if there was a way to instantly invest in hundreds or even thousands of different stocks with a single click, all of it managed by a team of pros whose entire job it is to find the best companies, that's exactly what a mutual fund is. In this video, I'm going to give you a simple, beginner-friendly breakdown of how they work, how you can use them to start investing today, minus the headache. This isn't about getting rich overnight. It's about building wealth without the stress. Welcome. If you are a young professional, you're probably juggling a demanding career, a social life, and maybe paying off some student loans. The last thing you have time for is spending your nights staring at stock charts and financial reports. But you also know that leaving your money in savings accounts means you're literally losing purchasing power, something we'll talk about more later, to inflation every year. You're losing that purchasing power every year that it's not making money for you. It feels like an impossible spot to be in. This is where mutual funds come in as maybe the most popular starting point for new investors, and for good reason. They're designed to solve the biggest problems beginners face: not enough time, not enough expertise, and not enough cash to build a safe, diversified portfolio from the ground up. In this video, we're going to follow a simple Q&A format to break it all down. By the end, you'll have a clear handle on, first, what a mutual fund actually is, using an analogy that will make it click instantly. Second, how they really work behind the scenes. Third, the three powerful reasons they are the perfect launch pad for someone just like you. And fourth, the main types of funds out there, just so you get the lay of the land. Fifth, the one key thing you absolutely have to look for, the catch, if you will. And finally, the simple first step you can take to get going. My goal is to make this intimidating topic simple. No confusing jargon, no crazy charts, just what you need to feel confident, ready to take control of your financial future. Let's get into it. So what on earth is a mutual fund? Let's skip the financial speak and use a simple analogy, the fruit basket. Imagine you want to start eating healthier, which means eating a wide variety of fruits. You go to the grocery store and you hit a wall. You want apples, oranges, bananas, grapes, strawberries. Buying a whole bunch of each is expensive. Plus, you're not sure which ones are good, which are ripe, or which might go bad before you get to them. It's a ton of work and a lot of risk. If you accidentally buy a whole bag of sad, mealy apples, your entire investment in healthy eating for the week is toast. Now, what if the grocery store offered a pre-made fruit basket? A fruit expert put this together, someone who knows exactly what's in season, what's high quality, and how to create a balanced mix. The basket has a little bit of everything: a couple of apples, a couple of oranges, a handful of grapes, and a few strawberries. You don't have to be a fruit guru. You don't have to spend all that money buying each fruit in bulk. You just buy one basket. And hey, if one of the apples is a bit bruised, it's no big deal because you have all of the other perfectly good fruit. You've just diversified your fruit intake for the week with one simple, cost-effective purchase. A mutual fund is the fruit basket of the investing world. Instead of fruits, it contains investments like stocks and bonds. A stock is just a small piece of ownership in a company like Apple or Google. A bond is basically a loan you give to a company or a government, and they agree to pay you back with interest. Instead of you trying to become an expert on hundreds of different companies, the financial version of inspecting every apple in the orchard, you can buy a share of a mutual fund. This fund is a pre-made basket holding small pieces of many, many different companies. If one company in that basket has a bad year, it's just one bruised apple. It's the other 99 or 499 companies in the fund can help balance things out. That's the core idea. A mutual fund is a collective investment that pools money from thousands of people just like you. That giant pool of money is then used to buy a wide variety of stocks, bonds, or other assets. When you invest, you're not buying individual stocks. You're buying a share of the whole basket, giving you a tiny piece of everything inside. How do they actually work? The people and the price. Okay, the basket analogy clicks, but how does this all work in the real world? Who's putting this basket together? How is the price set? It really comes down to two things: the fund manager and the net asset value, or NAV. First, let's talk about who's in charge: the professional fund manager. Every mutual fund has a person, or more often a team of pros who manage it. These are our fruit experts. Their entire job is to research companies, analyze the economy, and decide what to buy and sell for the fund. They're the ones deciding whether to add more apples or sell some bananas based on their expert analysis. This is called professional management, and it's a huge benefit. As a busy professional, you're essentially outsourcing the hard work of picking stocks to someone who does it for a living. You don't have to read dense financial reports or follow the market obsessively. The fund manager does it for you. Of course, this service isn't free, and we'll definitely get to that later, but the idea is you're paying for expertise and convenience. These funds are created and managed by what's called an asset management company, or AMC. Now, let's talk about the price. How do you know what one share of a mutual fund is worth? This is where the term net asset value, or NAV, comes in. Unlike a stock like Tesla, whose price is changing every second, a mutual fund's price is only calculated once per day, after the stock market closes. The process is pretty straightforward. At the end of the day, the fund adds up the total value of every investment inside, all of the stocks, bonds, everything. Then subtract any fees or expenses. The result is the fund's total net asset value. To get the price per share, they just take the total value and divide it by the total number of shares that investors like you own. So if a fund has assets worth 100 million and investors own 10 million shares, the NAV is $10 per share. If the next day the investments inside do well and the total value grows to 102 million, the new NAV would be $10.20 per share. Your share is now worth more. On the flip side, if the market has a bad day, the NAV will go down. When you buy or sell, you're doing it at that day's closing NAV. It's a simple system that removes the temptation for frantic, second-by-second trading and encourages a more long-term view. So to recap, you put your money in the fund manager pools it with others and invests it. The value of your investment, the NAV, goes up or down on how well that stuff inside the portfolio performs. Pretty simple, right? Why would a beginner specifically choose mutual funds? We've hit on some benefits, but I want to lay out the 3 game-changing reasons why mutual funds are the ideal starting point for young professionals who are new to investing. These 3 pillars tackle the biggest hurdles that stop most people from ever starting. The first, and maybe the most important, is instant diversification. You've heard the phrase, don't put all your eggs in one basket. In investing, that is the golden rule. Diversification just means spreading your money across many different investments, so the failure of any single one doesn't wipe you out. Let's be real, if you're starting out, you might only have $100 or $500 or maybe $1,000 to invest. Try building a diversified portfolio with that. A single share of a big tech company can cost hundreds of dollars. With $1,000, you might be able to buy into 2 or 3 companies. If one of them has a major scandal, your investment could get crushed overnight. That's terrifying, and it's what keeps a lot of beginners on the sidelines. A mutual fund completely solves this. With the same $100 or $1,000, you can buy a share of a fund that owns stock in 500 different companies. Suddenly, you're not riding on the success of just 2 or 3. You're diversified across technology, healthcare, consumer goods, energy, all different sectors. It's the single most effective way to lower your risk without needing a ton of money to start. The second powerful reason is professional management. As we said, a team of experts is managing the fund. Think about what that really means. Do you have the time to research whether a company's CEO is the right fit? Do you have the data to figure out if a company's debt is sustainable? Do you know how to read a balance sheet and project future cash flows? Probably not, but that's totally fine. You're a pro in your own field. You don't need to become a financial analyst to build wealth. By investing in a mutual fund, you're leveraging the time and resource of a full team of experts. This frees you up to focus on what you do best. Crush it in your career, which gives you more money to let the experts manage. It's a great cycle. The third reason is convenience and discipline. One of the biggest enemies of a new investor is their own emotions. It's human nature. When the market is flying high, we get FOMO, fear of missing out. We want to buy at the top. When the market is crashing, we panic and we want to sell at the bottom. That cycle is a guaranteed way to lose money. Mutual funds offer a brilliant solution to this, often called systematic investment plans, or SIPs, or automatic investing. You can set up an automatic transfer of a fixed amount of money, say $200, from your bank account to your fund every single month. This simple act of automation does two amazing things. First, it takes emotion and guesswork out of the equation. You're not trying to time the market, you're just investing consistently, which is key. Secondly, it builds discipline. Building wealth is a marathon, not a sprint. And those small, consistent investments are what build a huge foundation over time through the power of compounding. The convenience of set it and forget it is a powerful tool for building good financial habits. If you're already seeing how this combination of diversification, professional help, and convenience could seriously simplify your investing journey, do me a quick favor and hit the subscribe button. My whole goal here is to keep breaking down these big financial topics into simple, actionable steps, and subscribing ensures you won't miss what's next, and it's a great way to support the channel. I really appreciate it. Thanks. All right, you get what a mutual fund is and why it's helpful. The next logical question, are they all the same? And the answer is a big fat no. Just like there are different fruit baskets, some tropical, some have berries, there are many types of funds. Each of the funds have a different goal. Let's keep it high level for now, but here are the main categories you'll run into. First, we have stock funds, also known as equity funds. These are the most common type. As the name implies, they primarily invest in stocks. The main goal here is usually long-term growth because these stocks can be more volatile. These funds are best for long-term goals like retirement, where you have plenty of time to ride out the market's ups and downs. You might hear people say that if you have a long time horizon, then you're a better pick, usually for higher risk funds that might have more volatility. Within stock funds, they're often broken down by company size. Large cap funds, these invest in the big, stable household names. Think Microsoft, Johnson & Johnson, Coca-Cola. They're generally considered less risky. Mid-cap funds, these focus on medium-sized companies that are established but still have lots of room to grow. A bit more risk, but potentially higher returns. Now, small-cap funds, these invest in smaller, up-and-coming companies. They're the riskiest of the three, but also have the highest potential for explosive growth. Second, there are bond funds, also called fixed income funds. Instead of stocks, these funds invest in bonds. Remember, a bond is just a loan. These funds pool your money, lend it to a corporation or government. In return, the funds get regular interest payments, which it gets passed to you. The main goal of bonds is to generate steady income and be less volatile than stock funds. They're often used by people closer to retirement or who just don't like a lot of risk. Third, you have balanced funds or hybrid funds. Just like it sounds, these funds give you a mix of both worlds. They invest in a combination of stocks and bonds in a single fund. A common mix might be 60% stocks for growth and 40% bonds for stability. The idea is to get the growth potential of stocks while using bonds to cushion the ride during market downturns. For a beginner feeling overwhelmed, a single balanced fund can be a fantastic all-in-one solution to get started. Now for a crucial piece of the puzzle. Nothing in life is truly free, and that includes professional management and convenience of mutual funds. This brings us to the most important catch you need to know about, the expense ratio. The expense ratio is an annual fee the fund charges to cover its operating costs. The fund manager's salary, admin costs, marketing, you name it. This fee is shown as a percentage of your total investment. For example, if a fund has an expense ratio of 1%, it means you'll pay $100 per year for every $10,000 you have invested. You'll never get a bill for this. The fee is automatically taken out of the fund's assets, which means it slightly lowers your overall return. If a fund's investment earns 10% for the year and its expense ratio is 1%, your actual return is 9%. So why is this so important? Because while 1% doesn't sound like much, over 20, 30, or 40 years, that fee has a big impact, potentially costing you tens or even hundreds of thousands of dollars in lost growth. This leads to a critical distinction: actively managed funds versus passively managed funds, or index funds. An actively managed fund is what we've been describing. A fund manager is actively trying to beat the market by picking investments they think will outperform. Because this requires a ton of research and trading, these funds have higher expense ratios, often from 0.5% to over 1.5% to 2%. It just depends. Passively managed fund, usually called an index fund, does the opposite. Instead of trying to beat the market, its goal is to simply match the performance of a specific market index, like the S&P 500. No star manager is making brilliant picks. A computer just buys and holds all the stocks in that index. Because there's very little active management, the costs are dramatically lower. Expense ratios for index funds can be incredibly low, sometimes as low as 0.05% or even less. For most beginners, financial experts overwhelmingly suggest starting with low-cost index funds. Data has shown over and over that most active managers fail to consistently beat the index over the long term, especially after you factor in their higher fees. By choosing a low-cost index fund, you guarantee you'll get the market's return, and you make sure your money is working for you and not paying fees. So how do I get started? Okay, your head might be spinning a bit, but hopefully you're also feeling a sense of possibility. You know what mutual funds are, how they work, why they're great for beginners, the main types, and the absolute necessity of keeping costs low. So what's the next tangible step? How do you actually buy one? The process is simpler than you think. To invest in mutual funds, you need to open a brokerage account. Think of a brokerage account as a financial department store. It's a place you go to buy and sell all sorts of investments, including mutual funds. Firms like Vanguard and Fidelity and Charles Schwab are popular choices, and opening an account is usually a simple online process that can take just 15 minutes. You'll need some personal info like your social security number and bank account details for transfers. Once your account is open, you can browse their store and find mutual funds. You can search by the types we discussed: stock funds, index funds, and you'll see all the key information, especially all that important expense ratio. Don't feel like you have to pick the perfect fund right away. The most important step is just getting started. Opening the account is the first big domino to fall. After that, you can start small. Many firms let you begin investing with as little as $50 or $100. The goal is not to get rich overnight. It's to take the first step, build the habit, and you can get your money working for you and snowballing. It's the whole concept. Burp. A quick PSA though, a side note. If you are someone who has no clue what any of this is still, even after watching this video, you might be the right person to still have someone manage your portfolio for you. That might be a financial advisor. That could be a lot of different options. If stuff like this is just still going way over your head, which is fine, like we all have our different strengths, that might still be the right choice for you instead of just picking index funds that have a low cost ratio. So anyway, back to the video. Okay. So now you know more about mutual funds than 90% of the population. You have the knowledge to cut through the noise and fear that holds so many people back. Feeling overwhelmed by the stock market is normal, but it doesn't have to be permanent. You don't need to be a Wall Street genius to build wealth. You just need a simple plan, discipline, and a long-term mindset. The key is to start early, stay consistent, and let compounding do the heavy lifting for you. If this video helped clear some things up for you, please give it a thumbs up and subscribe for more simple breakdowns of financial topics. And now I want to hear from you. What's one big question you still have about investing? Drop it in the comments. I read every single one, and your questions help me figure out what to cover next. Thanks for watching, and I'll see you in the next one. I hope this video helped. Subscribe for more.